What is a balance sheet? And how can you read a balance sheet to get more information of a company's financial situation? What do the different balance sheet terms mean? And how do I understand the full picture? A balance sheet is an overview of what the company owns and what the company owes at point in time. What is owned is in the left and what is owed is on the right. The balance sheet is one of the three very useful financial statements that the company puts together and publishes. The other two financial statements are statement of income, an overview of the profits and the revenue earned by the company over a period, and a cash flow statement, an overview of how much cash the company earns and where it spends the cash during period. A balance sheet is like a photograph. It captures the financial position of a company at a particular point in time. The income statements and the cash flow statements both cover the flow during a certain period, usually a month, a quarter, or a year. So they are like a movie, each with its own focus. Most of the balance sheets are arranged according to equation. Assets equal to liabilities plus stockholders' equity. An asset is anything a company owns which holds some amount of quantifiable value, meaning that it could be liquefied and turned into cash. A liability is anything a company or organization owes to a debtor. A shareholder's equity refers generally to the net worth of the company and reflects the amount of money that would be left over if all assets were sold and liabilities paid. When reading a balance sheet, it is important to start off by looking the balance sheet by categories. Current assets, non-current assets are on the left. Current liabilities, non-current liabilities, and equity are on the right. Current assets are cash and other assets that are expected to be converted within a year. Non-current assets are long-term investment that cannot be converted into cash quickly. Current liabilities are amounts due to be paid to creditors within 12 months. Non-current liabilities are amounts owed that are to be paid after the period of 1 year. Equity on the balance sheet is the book of shareholder capital. That's how the balance sheet works on a conceptual level. In making a balance sheet, first, you need to determine the reporting date and period. Often, the reporting date will be the final day of the reporting period. Most companies, especially publicly traded ones, will report on quarterly basis, usually fall on the final day of the quarter. Second, identify your assets. Assets will be split into the following line items. Current assets includes cash and cash equivalents, short-term marketable securities, accounts receivable, inventory, and other current assets. Non-current assets includes long-term marketable securities, property, goodwill, intangible assets, and other non-current assets. Third is you need to identify your liabilities. Again, this should be organized into both line terms and totals. Current liabilities includes accounts payable, accrued expenses, deferred revenue, commercial paper, current portion of long-term debt, and other current liabilities. Non-current liabilities includes deferred revenue, long-term lease obligations, long-term debt, and other non-current liabilities. Fourth is you need to calculate shareholders' equity. If a company or organization is privately held by a single owner, then shareholders' equity will be pretty straightforward. If it is publicly held, this calculation becomes more complicated depending on the various type of stocks. Common line items includes common stock, preferred stock, treasury stock, and retained earnings. Lastly, add total liabilities to total shareholders' equity and compare to assets. In order to ensure the balance sheet is balanced, it will be necessary to compare total assets against total liabilities plus equity. To do this, you'll need to add liabilities and shareholders' equity together. Transparency is one of the principles in accounting, means offering a clear, concise, and balanced view of company's financial situation to shareholders. The importance of accounting transparency grew after several prominent business and accounting scandals and heightened government regulations that requires companies to comply with the specific reporting standards. The balance sheet, an overview of what the company owns and what the company owes at point in time, which can tell a very interesting stories about the financial situation of a company. Let's zoom into the balance sheet in more detail and review what is in each of balance sheet categories. Current assets, non-current assets, current liabilities, non-current liabilities, and equity. I will take you through the main items. Cash is the most liquid asset. Receivables are the next liquid asset as it's close to cash. You may ask yourself why Walmart has receivables then their customers pay cash or cards when they shop. True. Receivables in Walmart are primarily due to insurance companies resulting from pharmacy sales, banks for customers' credits and debit, and electronic bank transfers that take in excess of 7 days to process, government for income taxes, suppliers for marketing or incentive programs, and real estate transactions. Inventories are having a huge number, 44.4. Property and equipment in non-current asset is the single largest line item among assets on Walmart. Property and equipment is a non-current asset and it is a long-term investment. Operating lease and financial lease are new to the balance sheet. Whereas lease used to be off balance sheet, the new accounting requires lessees to recognize right of used assets and lease liabilities on their balance sheets. The goodwill on Walmart balance sheet is primarily related to Walmart International. The difference between the purchase paid for retail operations and the Walmart acquired, and the fair value of the net assets acquired in the business combinations. Now that we know the main items on asset sides of the balance sheet, it is important to put things into perspective by clearly identifying the top three in terms of size. Property and equipment as the first, then inventory second, and goodwill as the third. On the liabilities and equity side of the balance sheet, account payables, these are invoices received from suppliers but not yet paid. Accrued liabilities consist of, amongst other accrued wages and benefits, insurance-related liabilities, accrued taxes such as payrolls, and sale tax and deferred gift card revenue. Long-term debt due within 1 year. Within equity, the largest line item in terms of size is the retained earnings, part of the company's cumulative historical profits. Another interesting one is the non-controlling interest. It is related to Walmart acquisition in a majority stake in Flipkart, Indian e-commerce marketplace. The non-controlling interest is the part of shareholders' capital flip part that Walmart didn't buy but somehow has to account for. Because in the acquisition, Walmart assumed the asset and the liabilities. So the top three in terms of size is the first is equity, then account payables, and then the long-term debt. Let's now look into the balance sheet of a real-world company, retail company Walmart. Walmart's fiscal year runs from February to January, so we will be reviewing the year-end balance sheet of January 31st, 2020. Current asset, 61.8. Non-current asset, 174.7. Adding up to total assets of 236.5. Current liabilities, 77.8. Non-current liabilities, 77.1. And equity, 81.6. Per the accounting equation, assets equal liabilities plus equity.